Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand not only what we see in the global landscape, but also if we're making any important investment changes or decisions currently. You know, Ben Bernanke spoke yesterday. We wanted to wait till this Thursday morning to actually do an update, just to kind of give you a heads up what we're hearing and what we're seeing generally speaking. Ben Bernanke has basically stated that QE, basically the quantitative easing that's been going on for 4 or 5 years, may start to slow when the economy and when the indicators dictate. Now, in the last 2 or 3 weeks, we've actually seen quite a bit of a sell-off, and I don't want to see a big sell-off, but maybe about a 5 or 6% in various sectors of the overall markets, whether those are bonds, whether those are gold-related, real estate-related, stock-related, emerging market-related. We've definitely seen just a little bit of a sell-off. As I've always reminded not only our clients, but 2 to 5% movements up and down month by month are commonplace. So I would not be an emotional investor. I would not be worried about a 5% downward draft in a position or even in a portfolio, whether you're conservative or whether you're growth oriented. That is commonplace, and if you want to have the ability to make a return on your money, you're going to have to accept some light volatility. 2 to 5% movements happen anywhere from 10 to 15 times a year in all asset categories, not just the stock market, but we've clearly seen treasuries, one of the safest supposed assets in the world, actually drop around 8 to 10% just in the last 6 months or so. So at the end of the day, all asset categories can have some short-term volatility. Expect it and embrace it. Going back to Ben Bernanke, what he's basically telling you is this. The economy is showing signs of just slight improvement. Again, slow improvement, but slight improvement. What he's basically telling you is this. He's going to basically take away or slowly stop the bond purchases that he's been doing. Not completely take it away, but slow down the actual purchases maybe over the next 6 to 12 months. There's other stimulus that's actually taken place that he talked about that's going to continue, and if need be, he will change direction and support the overall economy and the markets if needed. So what this tells you is simple. The economy is slowly repairing itself. Slowly. They actually looked at raising their GDP guidance from about 2.5% to 3.5% going into the next year. So at the end of the day, they're looking for improvement in GDP. What that tells me is stocks will probably do quite well. Now what's interesting is emerging markets this year have been totally hammered and hit. Many of the emerging economy markets, even though these economies are growing faster than ours, many are down 20+%, down 20% year to date. While the U.S. market is positive around, let's say, 10% year to date, we're seeing a lot of the emerging market sectors actually down around 20%. We've avoided most of those, of course, and that's helped our clients, of course, reduce risk in the portfolio. We are looking to make a couple adjustments in our portfolio in the next week or so. So watch, of course, your confirms coming into your accounts. But at the end of the day, I firmly believe the economy is on a stable footing in the U.S. I see improvement, and so does Ben Bernanke. At the end of the day, we're going to up our allocation a little bit of equity-based investments, generally speaking, in the U.S. because those are our strongest sectors. And I believe small and mid-cap are going to lead the pack. We've already reduced some of our exposure to some of the bonds we own. Although the bonds that we own or the bond investments we own in our portfolio typically react not as crazy or wildly when interest rates slowly move up. Although even our income investments have been hit a little bit, and again, it doesn't concern us. But over time, all investments will have volatility. You as an investor need to embrace that if you want to have a chance to make a return on your money. Again, nothing goes up in a straight line and nothing goes down in a straight line. You're going to have short-term volatility after a nice run in many sectors. And again, the sectors that we typically own, generally speaking, are still the strongest relative strength sectors. We will be making a few adjustments in our portfolios because it's warranted and it's going to be needed in order to further gains as we progress into 2013. I think too many investors, and of course these would not be our clients, people that call my radio show on a regular basis, have been basically stuck in buy and hold. And again, I repeatedly warn investors about overloading the boat in bonds. If you're an investor mostly in bonds or bond funds or bond investments, year to date, you're probably down 5% year to date if you own what you perceive to be safe investments. I firmly believe the next 3 to 5 and 10 years for bond investors in traditional fixed income is going to be harmful to your portfolio. Of course, if you're a client and you have a question about your portfolio, please call the office. If you're not a client and want to become a client, call our office for a consultation. We always like taking on new clients who are nice people to do business with. Make sure you have yourself a safe and profitable week.